Imagine being the man who literally figured out why the planets move and how the universe functions only to lose your entire life savings to a trend you didn't even understand. That is exactly what happened to Sir Isaac Newton in the summer of 1720. He was at the peak of his intellectual powers, yet he fell victim to the South Sea bubble, losing roughly £20,000, a staggering amount that would be worth millions in today's money. He famously said he could calculate the motions of heavenly bodies, but not the madness of people. It is a haunting quote because 3 centuries later, it feels like we are standing in the exact same spot. We are watching companies like Nvidia and Microsoft climb charts at speeds that defy traditional financial logic, all powered by the promise of an artificial intelligence revolution. The big question we have to answer isn't just whether AI is a bubble, but whether we are making the same human mistakes that even a genius like Newton couldn't avoid. Whether we are at the dawn of a new industrial era or just inflating a massive financial balloon is the debate of the decade. When you see a stock chart move in a vertical line, history tells us to be very careful, because a technology's potential to change the world doesn't always translate into a safe bet for the investor. In this video, we are going to tear down the hype and look at the cold, hard numbers. We will compare the current AI frenzy to the legendary crashes of the past, from the South Sea Company to the dot-com burst of the 90s. We are going to look at price-to-earnings ratios, market psychology, and the fundamental difference between a story and a business. Today, we aren't just talking about stocks. We are exploring the history of human greed and the high price of missing out. Let's dive into the anatomy of a bubble and see if this time things really are different. The madness really began in the crowded coffee houses of Exchange Alley in London. By the summer of 1720, the South Sea Company had become more than just a business. It was a national obsession that crossed all social boundaries. On the surface, the promise was irresistible: exclusive rights to trade with the limitless riches of South America. But there was a massive, glaring problem that the public chose to ignore. Spain actually controlled those ports, and Britain was frequently at war with Spain. The company didn't really have a functional trade business. It was essentially a massive accounting trick designed to help the British government manage its mounting war debt. Yet, the narrative was so powerful that the stock price exploded from about £128 in January to nearly £1,000 by August. This wasn't just a functioning market anymore. It was a collective fever. Even the most rational minds of the Enlightenment weren't immune. Isaac Newton, the man who literally wrote the book on logic and gravity, initially sold his shares early in the year and walked away with a respectable £7,000 profit. But then he did the one thing that ruins every investor. He watched his less intelligent friends continue to make fortunes while he sat on the sidelines. Driven by pure, unadulterated FOMO, he jumped back into the market at the absolute peak with almost everything he owned. When we look at Nvidia today, we see a company that has added trillions of dollars in market capitalization in what feels like a heartbeat. It's tempting to say this is the exact same story, but as a historian, I have to point out a crucial nuance. Unlike the South Sea Company, which was a hollow shell selling a dream, Nvidia is an industrial juggernaut with real products, massive profit margins, and a dominant grip on the world's most important hardware. They aren't selling ghosts, they are selling the pickaxes and shovels for the AI gold rush. However, the ghost of 1720 still haunts the valuation. A bubble doesn't always require a fake product, it just requires a price that assumes nothing will ever go wrong for the next several decades. Back in 1720, they had sub-bubbles too, absurd startups raising money for projects like a wheel for perpetual motion or improving the art of making soap. Today, we see a similar pattern where any company that merely mentions artificial intelligence in an earnings call sees its stock price spike, regardless of their actual bottom line. We are betting on a future where AI solves every problem humanity has, just like they bet on South American gold. The lesson from Newton isn't that the technology or the trade was a lie, but that even a genius can't outsmart a price driven by pure adrenaline. When the South Sea bubble finally burst in September 1720, it didn't just take Newton's £20,000, it broke the financial trust of an entire generation. The most dangerous phrase in finance is, "This time it's different," and that was the anthem of the late 1990s. As we move from the distant history of the 1700s into the more recent memory of the dot-com bubble, the parallels to our current AI frenzy become almost uncomfortable. In the late 90s, the internet wasn't a scam, it was a legitimate, world-altering revolution, just as artificial intelligence is today. But the stock market didn't care about the long-term utility of the web. It cared about the immediate, intoxicating growth of companies like Cisco Systems. At the height of the boom in March 2000, Cisco briefly became the most valuable company on the planet. It was the Nvidia of the 90s. While everyone else was trying to figure out how to make money online, Cisco was selling the routers and switches, the literal plumbing of the internet. Their revenue was exploding, their margins were high, and the narrative was that they were the only ones truly profiting from the gold rush. But here is where the historical warning gets loud. Even though the internet did eventually change every aspect of our lives, Cisco's stock price was a disaster for the people who bought it at the top. At its peak, Cisco was trading at a price-to-earnings ratio of over 100, and some estimates put it closer to 200 depending on the month. Investors weren't just paying for the next 5 years of growth, they were paying for the next 50. When the bubble finally burst in April 2000, Cisco's stock plummeted nearly 90%. It took 15 years for the company just to see its stock price return to even a fraction of those highs, despite the fact that the company remained profitable and the internet became ubiquitous. The lesson is brutal. A company can be a winner in the technological sense and still be a loser for your portfolio if you pay the wrong price. When we look at the AI market today, we are seeing the exact same infrastructure phase. We are pouring billions into chips and data centers, much like we poured billions into fiber optic cables in 1999. Back then, we had an oversupply of infrastructure before we had the killer apps to use it. Today, the big question is whether the massive capital expenditure from companies like Microsoft and Google will actually turn into enough revenue to justify the trillions of dollars in market cap we've added to the sector. History suggests that there is always a gap between the birth of a technology and its profitable application. We saw it with the railroads in the 1800s, we saw it with the automobile in the 1920s, and we saw it with the internet in 2000. In every single one of those cases, the technology won, but the first wave of investors got wiped out because they mistook a long-term revolution for a short-term get-rich-quick scheme. As we watch AI companies trade at valuations that assume perfect execution for the next decade, we have to ask ourselves if we are buying the future, or if we are just buying the hype of the most expensive plumbing in history. Behind every great financial bubble, there isn't just a new technology or a speculative asset, there is a very specific recurring pattern of human behavior. If you look at the price charts for the Dutch tulips in 1637, the South Sea Company in 1720, and the Nasdaq in 1999, they all eventually start to look identical. They all trace a parabolic curve, a line that starts with a gradual slope and then suddenly turns into a vertical wall. This isn't a coincidence of math, it's a signature of the human psyche. We call this the mania phase. It's that intoxicating moment when this smart money has already made its entry, and the general public begins to feel a crushing sense of FOMO. In the 1700s, this happened through rumors in London coffee houses. In the 1990s, it was fueled by 24-hour cable news. Today, it's driven by real-time social media and algorithmic trading. The speed has changed, but the underlying panic, the fear of being the only person in your social circle who isn't getting rich, is exactly the same as it was 300 years ago. When we map the current artificial intelligence trend onto this psychological framework, we find ourselves in a very strange position. Usually, a bubble has 4 stages: the stealth phase, the awareness phase, the mania phase, and finally the blow-off. Right now, AI feels like it's firmly in the mania phase, where the new paradigm argument takes over. This is the point where people stop looking at traditional metrics like debt to equity or free cash flow and start talking about TAM, total addressable market, as if it's an infinite resource. We hear experts claim that AI will add $15 trillion to the global economy by 2030, and while that might be true, the market often prices in that entire 15 trillion today, leaving no room for the inevitable setbacks, regulations, or competition that history tells us will arrive. The danger of the parabolic curve is that it requires an ever-increasing amount of new money and even bigger good news just to keep the price from falling. The moment the news is just good instead of miraculous, the vertical line begins to roll over. What makes the AI chart particularly fascinating compared to the ones we've discussed is the sheer scale of the concentration. Never before in history has so much global wealth been tied up in so few companies. In 1720, the South Sea Company was the big player, but it was a localized British crisis. Today, if the AI narrative stumbles, it doesn't just affect a few tech bros in Silicon Valley, it hits every pension fund, every index tracker, and every retirement account on the planet. We are essentially watching a high-stakes social experiment where we've bet the structural integrity of the global financial system on the idea that the new paradigm is permanent. History warns us that new paradigms are almost always just the peak of the mountain. We like to think we are more evolved than the people who traded tulip bulbs or South Sea shares, but when you look at the vertical trajectory of AI stocks over the last 18 months, it becomes clear that our brains are still wired for the same madness that caught Isaac Newton off guard. We aren't just trading chips and software anymore, we are trading on the hope that this time the laws of financial gravity have finally been repealed. So, where does all of this leave us? Are we standing on the edge of a financial cliff, or is this truly the starting line of a new era for humanity? The reality is that the truth usually lives in that uncomfortable gray area in between. History shows us that you can have a world-changing technology and a catastrophic stock market bubble at the exact same time. The internet changed everything, but that didn't stop the Nasdaq from losing 80% of its value in the year 2000. The railroads connected the world, but they also bankrupted thousands of investors who bought in during the peak of the mania. Nvidia is not a hollow shell like the South Sea Company, and artificial intelligence is not a digital pet rock. It is a real, powerful, and transformative tool. But as we've seen, the smartest man in the world, Isaac Newton, didn't lose his money because he was wrong about the future. He lost it because he was wrong about the price. The ultimate lesson of financial history is that valuation always matters. Even if AI becomes the most important invention in human history, paying a price that assumes 100 years of perfect, uninterrupted growth is a dangerous gamble. We are currently living through a period of priced for perfection, where the market expects nothing but miracles. If the AI revolution stumbles even slightly, whether through government regulation, power grid limitations, or a lack of immediate profitability, the correction will be painful. As an investor, your goal isn't necessarily to avoid the revolution, but to avoid the madness of the crowd that Newton fell for. Don't let the fear of missing out drive your financial life, and never mistake a temporary price spike for a permanent law of physics. I want to hear from you. Do you think we are in a 1999 style bubble, or is the AI rally just getting started? Let me know your thoughts in the comments, and if you found this deep dive into financial history useful, make sure to like and subscribe for more. Until next time, remember that the most expensive words in history are, "This time is different." If you want to understand how financial history repeats itself, subscribe and join our journey.